What up, what up, what up, YouTube? I'm back. I got another divergence video for you. And we about to get right into it. Ain't gonna waste no time. Alright, so what up, YouTube? We starting off with the trading day, Monday, June the 16th. Alright, this is the 1 hour time frame. The first thing that happened today was the DXY ended up breaking short-term market structure on the 1 hour at 3 a.m. during the London kill zone. So these prices right here that I got marked out were the swing low. Right here, these prices were a failed swing high because we didn't get above these prices right here, which is the high. These prices were supposed to go from low, high, higher low, and it was supposed to make a higher high. Since we didn't make a higher high and we made a lower low instead, which was right here, automatically I was looking for higher prices in the futures because the higher time frame holds more weight, and this is the 1 hour time frame. So this is a little bit above the intraday uh time frame for the guys that day trade. So I was absolutely looking for lower prices, and this is at 2 a.m. Well, this is actually this the candle before it was 2 a.m. But this very last candle was 3 a.m. All right, so here we got the Nasdaq, the 1 hour time frame. Soon as the trading day started at 6 p.m. on Sunday, right? The market gapped up and it broke that. It soon as the new trading week started, the first hourly candle opened and gapped up to deliver prices above my 4 hour premium prices, creating a failed lower low and instead making a higher high. So we made a higher high right here. And this low basically we were supposed to go lower than these prices if we continue making bearish market structure. But in any event, we basically delivered prices into my premium prices. I already had these marked out from my weekly review, my weekly prep. And yeah, so we traded immediately as soon as the market opened up, we immediately traded into the premium prices. And we gapped up at that. So that was a strong sign of, you know what? The market is in a rush to get somewhere. So there you go. All right, so here we got the ES on the hourly time frame. When the new trading week started for ES, prices gapped below the opening and traded up. So on the NQ, prices gapped above the opening prices and traded straight into the 4 hour premiums. But on the ES, we didn't gap up. We actually gapped down. So this green candle, we opened up down here and then we traded all the way up. So these prices right here, I got marked out are the 4 hour premiums as a swing high. And that's how we opened up. That's how we started off the ES. All right. So here we got the NQ on a 15-minute time frame. So this line right here is that that 4 hour market structure, the premium that we gapped up and we traded above. Call coming in. Hold on real quick. Yeah, part of my distraction though, I had a call coming in from a correctional facility. Had to handle that real quick, but we're gonna get back to what I was saying. All right, so boom, 5:45. Market was continuing to deliver prices deeper into premium zones. Bullish market structure was in full effect. So I seen this happening on the Nasdaq. It's the 15. My premium prices got hit early, and then they kept bullish market structure was in full effect, and then they kept trading into my other premium zone. So I'm already knowing that, you know what, ES got to do the same thing eventually. So if you look right here, my 4 hour premium prices didn't get hit on the ES at the exact same time at 5:45. So at 5:45, while NQ was delivering prices into my premium zones and breaking short-term bearish market structure, ES was being weak by not delivering prices into its premium zones. At this time, I was anticipating a run on stops below the market to get long. So the NQ was already making higher highs and basically trading into the premium prices. The ES wasn't. So at that time, that's a divergence right there. I was just waiting for a run on some stops to basically get long and ride the move up into the premiums. All right, so this is what the chart looked like when I went long at 423. This price action right here, I looked at this as a run on stops. The market just dropped down, pulled back a little bit, and dropped down a little deeper, and ran these stops and ran these stops right here. So I looked at this whole price run right here as a run on stops, and I went long. I went long right inside of here. All right, so when I went long inside of these prices right here, right, the market went in a profit a little bit, and then it wiped me out. It wiped me out, and it basically ran all of these prices right here. They ran all of these prices. This was the run. This was the real run on stops right here. So it built up some liquidity, and then it basically delivered price underneath these prices right here, underneath these prices right here, all the way to down here. So when I got liquidated out the market, I had too many contracts on. I just said, I'm going to sleep. I'm going to take the loss for the day and it's over. So I woke back up at 7:30, right? And I saw that I was still on the right side of the market. So I got in again. After this run on stops happened, this was 7:30. I got the line on the 7:30. The market basically, when I came back and I started to read the price action, I started to see that this was just a run on stops. And ever since then, the market has been going higher, just slowly, but it's been going higher. So I got back in with too many contracts right inside of these prices right here. And this is how it played out.